Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show and plenty to talk about today. New all-time highs in the US, the local market muddling along, and then some interesting moves in the commodities to talk about as well. Plus, any stock codes you have, get them ready. We're going to go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's get into this week's first chart. And starting off with the ASX 200. Well, could the ASX 200, could this be forming a base, or is something more concerning developing? I'll talk a bit more about this in a moment. And then over in the US, the S&P 500 is on the verge of its ninth up week in a row. I'll tell you what typically happens after these record runs in a moment, and it's not what many people expect. But before we get to that, let's start with this latest price action in the ASX 200. Well, there's an interesting setup developing in the ASX 200, and there are two opposing sides to what's going on. So firstly, prices continue to consolidate below the moving averages. And you'll also see that these moving averages are trending lower. And when that happens, it creates a layer of vulnerability. When prices consolidate below declining moving averages, it often puts them at greater risk of a large sell-off. The ASX 200's price action, well, it's also been generally sagging over the last 6 or 7 weeks. And you'll see this persistent selling pressure that's been driving the market lower since April. So this could all be seen as bearish developments. But here's what I find interesting: despite what could be a bearish backdrop, the selling has never really been, like all through this period here, the selling's never really been overwhelming. It's never attracted that follow-through selling that's so characteristics of markets really breaking down. So instead, we've got this choppy, grinding decline, and the way it is, choppy pullbacks like this are often counter-trend pullbacks, not an emerging downtrend. And counter trend being, well, we had a strong rally off the March low and then the counter trend pullback. I think the key now is for enough buying pressure to build to flip the price action back above the moving averages. I think that's the key now. That would be the first sign of active buying returning. And that would also leave behind a basing structure. So when I say a basing structure, I mean where you get lower lows turning around and becoming rising highs. So that's the potential for a basing structure. It could look something like if prices were to flip back above the moving averages, you get potentially the structure that can lead prices higher from there. Declining lows turn to rising lows. That's the sort of price action I'm keeping an eye out for now. But until that happens, of course, that hasn't happened yet. Until it does happen, we need to respect that prices are below declining moving averages. And while the pullback does appear corrective, risk is just naturally elevated when prices are below declining moving averages. I think the lows from a couple of weeks ago, these lows here from a couple of weeks ago are important. I think they're really important to monitor at this point. I think they're the key to the last 4 weeks being a basing period. So if this period from the last 4 weeks is to be a basing period, these lows from a couple of weeks ago really need to hold. If the recent lows break, if these lows were to break, then instead of rising lows, we end up with a series of lower lows. Like, for instance, if prices were to reverse from current levels and break to a new low, well, then we have declining lows, which then can continue to unfold to the downside. That's the risk. That's the risk to keep an eye out for. Of course, that hasn't happened yet, and hopefully doesn't happen. So these lows holding, I think, is very, very important. At this point, I think there's reason to believe prices are basing around current levels. So what could lead to a break above the moving averages? What could cause prices to flip back above the moving averages? Well, let's have a look at we'll start by having a look at the materials. So this is where we find the mining stocks. So this is the ASX 200 Materials Index. I've been favouring a longer consolidation. So we had this low point back in April last year, about an 83% rally or thereabouts over something like 10 months. I've been favouring a longer consolidation between the high and between the low, like a big ranging period perhaps. But I'm also open. And I still think that's entirely possible, but I'm also open to the potential that prices regain momentum potentially in the near term. What impresses me is the strength of the rallies off the 50-day moving average. So just expand this a bit. Look at these last couple of rallies off the 50-day moving average. Prices have come back to the average, and then there's been strong buying, pushed prices higher quickly, and again just recently pushed prices higher over the last like week and a half. So I think that buying pressure off the averages is, I think that's worth noting. While it's only been a couple of days, the latest rally is doing a good job of holding onto its gains. So you can see the rally from the lows Wednesday last week, strong rally. So far, it's holding those gains, but as I say, it's only a couple of days. Nonetheless, that's a sign buyers are quickly stepping in on dips. I think that's very positive. If prices can hold around current levels, if we can see the materials holding around current levels, maybe for a week or two, well then I think it's that could set up a platform for a run at the all-time high. Let's just see what the price action delivers. I think that's a possibility. That could be one of the things which could flip the ASX 200 back above its moving averages. Then, of course, we've got the financials being the other big sector, and prices remain below declining moving averages. Moving averages are pointing lower. Prices are below those moving averages. They're also trading near the lower end of the 7-month trading range. So let's put our range on. That's the trading range for the financials over the last 7 months. This is still an area of vulnerability. Financials haven't broken down, but there's increased risk while prices below these moving averages, and the moving averages are declining. What I'm watching now is this latest pullback, how it develops. So financials had a nice rally off the low from the middle of the month, nice rally over about a week and a half. And so far, it's doing a good job of holding onto those gains. That's encouraging, and I think it's an early sign of some buying interest. Although I think there's more work to do. It's only really a few days in. I continue to view financials as being in an ongoing consolidation. Like, this is my favorite view, that it's an ongoing consolidation and that ultimately that leads to higher levels. But while prices are below these moving averages and the averages are in decline, it is a risk and it's something we need to monitor. Let's see how this price action develops over the next week or two. Just quickly finishing up on the ASX 200. This could very well be a basing phase for the ASX 200, but I still think it's a case of just being patient. I think that's the best we can do now, being patient, not preempting it, doing anything, but being patient and waiting. Unless I see a good risk-reward opportunity, I'm just not in a rush to do much buying now. There are some signals appearing which are worth considering, and I have added some stocks in like the last couple of weeks, but I'm not doing a lot of buying, and largely because there's not a lot of signals at the moment to do buying. This ranging period will resolve. They all do, and trending conditions will return. Prices don't stay locked in these big trading ranges for forever. But for now, I think it's about managing risk and just waiting for those right setups to come to us. Now, I'm going to do the US market next. First of all, though, if you're getting some value, please click that like button. Leave a short comment. Tell me what you think. Tell me whether you think we're going to break out, break down, stay stuck on a range. It's always interesting to see how other people are viewing the market. But please click that like button. It helps me so much because YouTube sees people are engaging and they show other people, and that helps make this whole process work. So please do that. Click that like button whilst you're thinking about it. All right, over to the S&P 500. Well, after the briefest of pauses, the S&P 500 hit its 21st all-time high for the year on Thursday. And in doing so, the S&P 500, it's on track for its 9th up week in a row, depending on what we get for Friday in the US. Of course, we're going live here at about 10 past 1 on Friday afternoon in Sydney, so we're yet to get Friday in the US. But as it's looking at the moment, I think there's a good chance we're going to get the 9th up week in a row. Now, should that happen, that will equal the 9-week winning streak from late 2023. I think what's so interesting about these winning streaks is that many people often believe that they're a sign that the market must be close to a top. They say, well, look, after such a big winning run, that's got to be close to where it must be a top. Many people would rather, what I find many people would rather do, they'd rather take profit up here than to stay with winning positions. Of course, like there are going to be, with these things, of course, there's going to be pullbacks along the way, and winning streaks don't continue endlessly. But what we often find is that winning streaks have a tendency to lead to higher levels in the weeks and months ahead, and that the pullbacks that we do get, they tend to be mild, and price often then continues higher. So I'll show you now. I've just mentioned there was a record period of, there was a 9-week winning period in 2023. Let me show you what that looked like. Let me show you how that played out. Let's just go back here. So this is the area in question in the blue box. So look at this shaded area. We've got this 9-week rally. Big move. It's about 16.5%, just a little bit. I think the current move is about 19%. So not too far off what we currently have. It's about a 16% move over 9 weeks. And then we got the briefest of pullbacks in the 10th week, but then after that, prices continued higher for another 3 months before there was a larger pullback towards the moving averages. And even then, when we look at what happened after that, prices continued to rise for the rest of the year. So that was another 8 or 9 months. So now, this isn't to say that the current rally will go the same way. So we just come back to current day. It's not to say the current rally is going to do exactly what happened back in 2023. It's going to have its own unique course that it follows. We'll see how that develops over time. But don't make the mistake of thinking that the market has to top out because it's had a good run. Having a good run is not a reliable indicator of a market top. To the contrary, it's often an indicator that the market's got further to go. Despite what the skeptics say, and there are plenty of skeptics, I see them online, I see them in the media, people who disbelief in the rally, arguing that the market shouldn't be doing what it's doing. Despite what they say, this is an uptrend. Whether we like it or not, whether you believe it or not, it is an uptrend. And the path of least resistance remains higher until the market signals otherwise. So as I said last week, trends have a habit of surprising people. A strong trend can last longer and travel further than most people expect. And we're seeing an example of this now. I don't think a lot of people were expecting this rally to continue the way it has. But that's trends. That's why we let trends run. We don't try and, at least why I don't, at least try and pick tops and trends. None of this means to be complacent. We always need to manage risk. But as it stands, I want to stay with what's working. I don't want to bet against it. I don't want to bet against a market which continues to hit all-time highs. Quick look at the Nasdaq. Prices are at new all-time highs here as well. And again, after the briefest of pullbacks, the pullback coincides with an extreme in an indicator we've been watching. So this indicator down the bottom, it shows the percentage above or below the 50-day moving average the market currently is. And just in the last few weeks, the Nasdaq reached an extreme above its 50-day moving average, and then we've since had that pullback. But rather than signaling a top, an extreme in this indicator is a sign of bullish conditions. And what it does, it often leads to more gains after a mild pullback. So, is this now the mild pullback complete? It's interesting. Let me just come back here. Let me show you what happened. I'll show you an example this is an example from 2020. So let me just expand this out. So here's where the indicator first reached an extreme. Mild pullback over a few days, and then the market went onto new highs. It had another extreme a few weeks later. Again, another mild pullback, and then continued onwards. Had a larger pullback sometime after that. But nonetheless, it was a case of reaching an extreme, brief pullback, moving onwards again. So the extreme was a sign of strength. It wasn't a sign of an oncoming top. It was an indicator of a strong market. So again, what happened here? What happened in 2020? It's not necessarily going to play out like that again now. It probably won't. It will have its own, as I said before, have its own unique price action. So past cases aren't a roadmap for now, but they do show what's possible and why we should be open. Why, at least I think, we should be open to the possibility of an ongoing bull market, and not just thinking it's gone too far. It's got to end soon. Quickly on the Dow. The Dow Jones, it also hit an all-time high through the week. That's the first all-time high for the Dow since before the sell-off occurred from early February. So we now have a setting where all the major US indices are now all in alignment. They're all confirming with new all-time highs. And this also includes the small caps, which I'll discuss in a minute. I like the shallow consolidation so far. It's only a few days, but so far it's a strong rally followed by a shallow consolidation, and that suggests interest in buying the dip. I think we'll likely see new all-time highs in the near term for the Dow. I keep hearing people arguing about keep hearing the argument that there's not strong enough participation. That participation in the US market isn't strong. And because of that, they say the rally that we're seeing is not sustainable. They say it's a narrow rally. It's just tech. It's just big stocks. But I just don't think that's right. Not from the information or the data I look at. Have a quick look at this. This is a percentage of Russell 3000 stocks above their 100-day moving average. So the Russell 3000 covers pretty much the entire US market. The Russell 2000 is the small caps. The Russell 3000 covers the vast majority of the market. So, have a look at this. So, breadth, which is another word for participation, breadth has actually been improving since the lows of March. So, the percentage of stocks above their 100-day moving average got down to just above 30% in the second half of March. It's improved to 64%. It's pulled back, but now it's rallying again, and it's now at around 58%. So more than half of stocks are above their 100-day moving average, and that percentage is increasing. I think there's scope for this to continue to build and for this indicator to continue to move higher. And should that happen, well, that's likely to be supportive of higher prices. So just wrapping up on the S&P 500, I think the play here is staying long the US market. And that's what I'm doing. I think the odds favour that this one has, I think it has further to run. Of course, notwithstanding mild consolidations, but I think it has further to run. But like I said earlier, don't be complacent. Risk management is essential, as it always is. And that's about knowing your exit strategy in the event that what you own reverses course, because that's always going to happen at some point, unless, of course, a stock gets taken over. But stocks and markets, they do reverse. That's why we have exit strategies in mind before that happens. But until that happens, I think it's a case of letting the trend run, and that's where the money's made. The money's made by letting these trends run and coupling that with a risk management strategy. Okay, so I'm going to jump over to the US small caps now. We've got the Aussie small caps. We've got the commodities. Any stock codes you'd want me to have a look at, get them ready. We'll go through those a little bit later on. But of course, that wraps up the free section. Your nice strategy session. Remember, there's a link below. Click it. Come on in. Cost you very little. And we talk about a lot of things which could help you. So think about doing that. And for the little money it's cost, I think there's a whole lot of upside value in that. Okay, so let's now go over to the Russell, the US small caps.